And now to your Money Watch. It's been a roller coaster start to the new year for the stock market, and we're looking at what's causing the volatility. Joining us now from Armstrong Advisory Group, the managing partner and chief investing officer, Chuck Zodda. First off, Chuck, the Chinese tech surprise, the threat of tariffs, how reactive has the market been to all of these new headlines?
Well, I think it's been paying attention to a certain extent, but it hasn't fully bought into a number of them that have come across, the TV screen. So on Monday, as an example, we had markets open, down a little more than 1%. The Nasdaq was off a little bit more there. But ultimately, if the market really believed that tariffs were going to be going into place on Mexico, Canada, and China, it would have been a far greater dip in markets. And sure enough, we saw 2 out of the 3 of those tariffs reversed before the end of the day. So I think this is a market right now that, at least when it comes to some of the more potentially damaging things from the new administration that they're talking about doing, it's not really believing that they are going to go forward with those, but rather viewing them as potentially negotiating chips. And so I think that certainly there's been some volatility, but it hasn't been because of the actual implementation of anything yet. It's more simply the discussion that's been causing the volatility, and that's what we've seen to this point.
Are there any sectors that are more sensitive to the Chinese tariffs than others?
Well, I think certainly you look at what we import from China, and it's a host of different items. There's $500 billion plus in imports that the United States has from China. But you talk about, where a lot of it is just that we see on a regular basis. It's a lot of consumer goods, a lot of the things that are small dollar value that we are buying on a daily basis. Those things are typically produced in other countries where the cost of labor is much lower. So, it can be anything from toys to clothing, any kind of electronics. There's a whole bunch of stuff that gets produced over there, but anything that's consumer facing is front and center when we're talking about what we're seeing right now. And obviously the impact there is potential, higher costs for families, depending on how this ends up playing out and how long these tariffs are in place. So I think it's something right now. We still don't have any clarity on how long this is going to be in place with these new 10% tariffs on China. And certainly there's the possibility that's been floated by the Trump administration that those tariffs could continue to rise in the coming months, depending on how things are going on the trade front and whether the Trump administration gets what they are looking to from trading partners such as China.
Now, some people might see this potentially as an opportunity to take advantage of that dip. Is now a good time to buy some of these tech stocks?
So here's the thing. You never know if it is a good time to buy until after the fact. And certainly for the last 10 to 15 years, it has been the case that, hey, buying dips has worked, but there have also been long periods in American market history where that has not been the case. And so it's difficult to be able to say, hey, this is, definitively something that you should or should not be doing, just because if we're being completely honest, you never know exactly how the market is going to end up playing out. And the other piece that you have to remember is that every investor has a different risk tolerance and a different time horizon. Someone who might need the money 6 months from now probably shouldn't have it anywhere near the stock market to begin with, whereas someone who's looking to save for a retirement that's 30 or 40 years out has an entirely different profile in terms of the things that they should be considering and how they can approach something like this. So it's really difficult and actually impossible to say, yes, you should do this or do that, because there are so many variables that go into it with each investor's individual situation.
Absolutely. Always a risk there. Now, the Fed paused interest rates again in January. Do you think that we'll see another rate cut this year?
It certainly is a possibility. I think that we still need to see exactly what policies get implemented by the new administration, because there's a wide range of outcomes as far as how that could potentially affect both inflation and growth. There's a world in which we see inflation continue to come down and the Fed can resume cutting interest rates before the end of this year. There's also one where, hey, if tariffs cause inflation or if higher oil prices show up for any reason, you could potentially see see interest rates actually moving in the opposite direction and starting to move back up. So there are a whole bunch of different things that we're still trying to get a handle on, just because we've still only been into this new administration for a couple of weeks, and we're still trying to figure out, exactly which policies are going to be enacted on which schedule. And so until we have a little bit more clarity there, I think that there's still, a lot of challenge in trying to predict where interest rates are going to go. But rates moving down is a possibility. It's just not one that I think we can conclusively say is where we're heading at the moment.
Chuck, we always appreciate your expert advice from the Armstrong Advisory Group. Thanks so much for joining us today.
All right. Thank you.